PayPal, down 78%. Wall Street says it's dying. I just made it 10% of my portfolio. 69% upside target. The Q3 numbers prove the turnaround is real and the market hasn't noticed yet. Let me show you why. But before we dive into PayPal, let me establish why you should listen. I run Tom Alpha Trades, a portfolio that's returned over 441% since inception. This year alone, we're up 74.7%, crushing the S&P's 16.9% return by more than 4 times. My edge? I find high-conviction opportunities the market has systematically mispriced. Stocks where the narrative is broken, but the fundamentals are inflecting. Last week, I recommended NU Holdings at $15.8. It's already up 10% in 7 days. Today's deep dive on PayPal is the largest position I've built this year, 10% of my portfolio. And you're about to see why. Here's the setup. PayPal trades at $62.70. My 24-month price target is $106, a 69% upside. That target is backed by 3 visible, measurable catalysts that are already showing results, not hopium. This is a 10% portfolio allocation for me, which means I've sized it as a barbell position, large enough to matter, but with a margin of safety that protects the downside. For years, PayPal's valuation has been collapsing. You're looking at a chart that tells a brutal story. In 2019, PayPal traded at a 28.5 times PE multiple. By 2021, it hit 32 times. Today, 12.6 times, a 43% discount to its own 5-year historical average of 22 times, and a 43% discount to payment peers like Visa and MasterCard. Why? The market narrative has been dominated by 3 fears: losing share to Apple Pay and Stripe, slowing growth in branded checkout, and a lack of innovation. The stock has been priced for terminal decline. But here's the thing about inflection points. They happen when everyone is looking the other way. And that's exactly what's happening here. This is not a hope-based thesis. The Q3 2025 results provide concrete, irrefutable evidence that CEO Alex Chris's strategy is working and momentum is accelerating. Let me walk you through 4 data points that prove this. First, margin expansion. Transaction margin hit 3.49%, the highest in 2 years. This isn't a one-quarter fluke. It's the result of ruthless operational discipline and better pricing power. Second, branded growth is back. Branded checkout TPV accelerated to 8% growth, reversing years of decline. The core business isn't dying, it's re-accelerating. Third, Fastlane is exploding. New product velocity is off the charts, with Fastlane adoption growing at 60% month over month. This is the fastest launch of any product in PayPal's history. Fourth, management raised guidance. Full year 2025. EPS guidance went up to $5.10, a 15% year-over-year increase. The data proves the transformation is real. The market just hasn't priced it in yet. Our 69% upside case is built on 3 catalysts, and the beauty is that they're all already live and delivering measurable results. Catalyst 1. AI Agent Commerce. PayPal is positioning itself as the essential payment layer for the $5 to $10 trillion AI agent economy, with partnerships already secured with OpenAI, Google, and Meta. Catalyst 2. Fastlane Acceleration. This is PayPal's unbranded guest checkout mode, leveraging 432 million stored credentials to deliver one-click checkout without the PayPal button. It's growing at 70% monthly and adding $600 million in high-margin revenue by 2027. Catalyst 3. Branded Re-Acceleration. The core business is back. 3 consecutive quarters of accelerating growth prove the turnaround is working. Here's the opportunity most investors are completely missing. When AI agents start buying things for us, and they will, they're going to need a trusted, global, regulated payment network. PayPal has first-mover advantage, and the moat is already being built. Why does PayPal win? 3 reasons. First, trust and scale. 432 million user accounts with stored credentials create a network effect that AI agents can't replicate overnight. Second, global reach. PayPal is licensed in over 200 countries, a regulatory moat that takes years to build. Third, integration-ready infrastructure. APIs are already live and optimized for rapid deployment. And the partnerships? They're not theoretical. OpenAI integrated PayPal into ChatGPT for 100 million plus users. Google Gemini made PayPal a preferred payment partner. Meta enabled native payments in WhatsApp and Messenger. Perplexity added Buy with PayPal directly in AI search results. This catalyst alone represents massive upside optionality that is not currently priced into the stock. Fastlane is one of the most underrated products in PayPal's arsenal, and the traction is explosive. This is a one-click guest checkout that leverages PayPal's network without requiring the PayPal button. For merchants using Braintree, it's the ultimate conversion weapon. The Q3 numbers are staggering. 60% monthly merchant growth, 70% monthly TPV growth. This is the fastest adoption of any new PayPal product in history, driven by a 7+ percentage point conversion lift for merchants. But here's the competitive edge. Stripe and Adyen cannot replicate this. They don't have a network of 432 million stored user credentials. Fastlane unlocks a $1.2 trillion addressable market and is on track to generate over $600 million in incremental high-margin revenue by 2027. This is a financial impact that will show up in the numbers, and Wall Street will have to re-rate the stock when it does. For years, the bear case on PayPal was that branded checkout, the iconic PayPal button that drives 70% of revenue, was dying. The data now proves that narrative is dead wrong. Look at the chart. Q1 2025, 6% TPV growth. Q2, 7%. Q3, 8%. 3 consecutive quarters of acceleration. This isn't a temporary bounce, it's a re-acceleration driven by sustainable product improvements. And margins are expanding too. Transaction margin hit 3.49%, the highest in 2 years, proving that PayPal's pricing power is returning. The growth is being driven by real product enhancements, like a 50% faster checkout experience, not gimmicks. The core business is not only alive, it's strengthening, and that changes everything about how you value this company. Beyond the growth catalysts, PayPal is a mature, profitable, capital-light network generating immense free cash flow at scale. This is not a speculative growth story, it's a financial powerhouse trading at a deep discount. Let me walk through the metrics. Operating margin is 18.7% and expanding toward 22% plus as scale kicks in. Return on invested capital is 19%, more than double the weighted average cost of capital, which means every dollar reinvested creates real value. Free cash flow over the last 12 months, $5.6 billion, and the balance sheet, a fortress. $20.9 billion in net cash with zero leverage risk. Compare this to a so-called story stock, and the contrast is stark. PayPal isn't a bet on some distant future. Now, it's a financial powerhouse trading at a deep discount because Wall Street is fixated on yesterday's narrative instead of today's data. This is the kind of setup that generates asymmetric returns. Let me show you exactly how we get to $106 over the next 24 months. This is not a finger-in-the-air target. It's built from the bottom up using conservative assumptions. Step 1. EPS growth. I'm modeling 30% EPS growth to $6.46 by 2027, driven by margin expansion, Fastlane scaling, and aggressive buybacks. That adds $18.65 to the share price. Step 2. Multiple re-rating. As execution continues and Wall Street recognizes the turnaround, the PE multiple expands from 12.6 times today to a still conservative 16.4 times. That's a 26% discount to PayPal's own 5-year average. This adds $24.55. The math is simple. $62.70 today plus $18.65 from earnings growth plus 24.55 from multiple expansion equals $106. 69% total upside. And here's the kicker. Even with zero multiple re-rating, 2027 EPS at today's depressed 12.6 multiple still implies $81. A 30% upside with built-in downside protection. Some of you are thinking 16.4 times PE sounds ambitious. Let me show you why it's actually conservative. Versus history. Our target represents a 26% discount to PayPal's own 5-year average of 22 times. We're not asking for a return to peak valuations, just a modest step toward normal. Versus payment giants. Visa and MasterCard trade at 28 to 32 times PE with slower growth. PayPal is trading at a 40% plus discount despite superior margins and faster growth. Versus fintech peers. Block trades at 15 to 18 times PE despite having 10% operating margins compared to PayPal's 20%. And here's the downside protection. Even with zero multiple re-rating, 2027 EPS of 6.46 at today's 12.6 multiple implies $81, still 30% upside. A re-rating isn't just possible, it's probable as execution continues. Let me show you the forward trajectory. These projections assume a balanced mix of branded checkout reacceleration, new product contribution from Fastlane, and operating margin expansion. Revenue growth. I'm modeling a 7.1% revenue CAGR from 2024 to 2027, reaching $37.7 billion. That's conservative and achievable. EPS growth. 14% EPS QAGR, reaching $6.46 by 2027, driven by margin expansion and buybacks. Free cash flow. Expanding from $5 billion today to over $7 billion by 2027, giving PayPal enormous capital flexibility for buybacks and strategic investments. The key assumptions are realistic. I'm not betting on a miracle. I'm betting on execution of an already visible plan with early proof points in the Q3 data. If Fastlane scales as projected and branded stays on its current trajectory, these numbers are highly achievable. No investment thesis is complete without acknowledging the risks. So let's be honest about what could go wrong. Risk 1. Competition and market share loss from Apple Pay and Stripe. Mitigation? PayPal is differentiated by its 432 million user network, and Fastlane creates a structural moat. Branded checkout is already reaccelerating. I assess this as medium probability, medium impact. Risk 2. Execution risk on the transformation. Mitigation? CEO Alex Chriss has a strong track record. Q3 results show early wins and board support is rock solid. Low probability, medium to high impact. Risk 3, macro slowdown in e-commerce. Mitigation? E-commerce penetration still has a long runway. Venmo and P2P are less cyclical, and PayPal's growth drivers are company-specific, not macro-dependent. Low probability, medium impact. Overall risk rating? Moderate. But the risk-reward is highly asymmetric at approximately 3 to 1 or even 4 to 1, which is exactly what we want in a high-conviction position. Let me summarize why this is a strong buy. Deep value. PayPal is trading at a 43% discount to peers despite superior quality. 12.6 times PE, 19% ROIC, and a fortress balance sheet. Visible catalysts. 3 clear, measurable drivers are already delivering results. AI agent commerce, Fastlane acceleration, and branded re-acceleration. Proven execution. New management is beating expectations and raising guidance. The turnaround is working, not theoretical. Durable moats. The 432 million user network provides a structural advantage that competitors cannot replicate overnight. Asymmetric risk-reward. A clear path to 69% upside with protected downside. The reward-to-risk profile is 3 to 1 to 4 to 1. This is an opportunity to buy a high-quality, profitable industry leader at the inflection point of a proven turnaround, with significant AI-driven optionality not yet priced in. I've made it 10% of my portfolio. That's how convicted I am. Investing isn't just about making the trade, It's about tracking the thesis over time. Here's exactly what I'll be monitoring every quarter to ensure this story stays on track. Green flags that confirm the thesis. Fastlane merchant growth above 50% quarter over quarter. Branded checkout TPV growth above 7% year over year. Transaction margin holding above 3.4%. Operating margin expanding. New AI agent commerce partnership announcements. Red flags that would force a reassessment. Fastlane growth decelerating below 30%. Branded checkout TPV declining. Margin compression below 3.2%. Key management departures. I will monitor these KPIs quarterly and provide updates to ensure the thesis remains intact. Discipline is what separates great investors from lucky ones. Thanks for watching. For full deep dive analyses and real-time trade alerts, visit www.tomalphatrades.com and follow me on X at @tomalphatrades, where I share real-time updates on all my portfolio positions.